Hello and welcome to the Laundromat Ownership Podcast. I'm your host, Ian Gollahon. Me and my business partner, Brian Henderson, own a chain of laundromats in Tulsa, Oklahoma named Liberty Laundry. In 2025, that small chain of 3 stores did $2.5 million top line revenue. But we are also the founders of Wash-Dry-Fold POS, which is the original point of sale system for laundromats. Over the last 10 years in that company, I've talked to over 3,000 laundromat owners, and I've learned a lot of really interesting stuff, some of which I'll be able to share with you on the podcast today, and some of which I vowed never to speak of again. So this episode is going to be a little bit of a throwback to our first episode, which was on laundromat valuation metrics. And that episode got a lot of interest. The first article is out now on, we've made it into essentially a 4-part series in the Full Cycle magazine. Now, for those of you that aren't familiar with the laundry industry, Full Cycle is the laundry magazine of the CLA. It used to be called Planet Laundry, but it recently has gone from a monthly magazine called Planet Laundry to a essentially a quarterly multimedia brand called Full Cycle. And one of the reasons that this talk was kind of adopted into this, it's going to be essentially an 8-page, 4-part series, is because it is actually pretty complicated how you value businesses, right? If you know anything about the stock market and how there's usually some correlation to earnings with the value of a stock. But we also know that that's not the only thing that values a company, either public or private. There are a lot of pieces of it. And so we're going to talk about how you arrive at a good market valuation for a laundromat, whether you're buying it or selling it, or just trying to assess it in your own portfolio. What is it actually worth? What's funny is if you go to some place like, let's call it a Facebook group, I sometimes see people post, hey, I'm buying my first laundromat. What is it worth? And it's essentially a race to who says the only thing that matters is just take some multiple of net earnings. But in a laundromat, your net income is the amount that you get taxed on. And so there are quite a few incentives to reinvest in the business instead of claiming all of that revenue as net income. And we will go over that in depth, but I just wanted to address the first thing, which is everyone says, oh, it's worth some type of multiple of net income. If you don't understand the different levels of earnings, you're really not going to even know what number to start with to give a multiple. And so I'm going to just show you here based on the chart real quickly, gross revenue. A lot of times you'll hear people say, 1 to 2 times gross. SDE is what most brokers actually use. It's seller discretionary income. That's typically when you buy a laundromat, what it's based on. EBITDA, we'll get into that, but it is typically a reduction of SDE because you're essentially saying, I'm going to hire someone to run and manage this laundromat for me. I'm not going to be the person that runs and manages it. And then, of course, free cash flow, that is really more of a banking metric that banks use. And then net income is what you get taxed on, right? And that's that little circle there. So we're going to go over all these throughout the life of this series. But I wanted to really kind of pace it along with Full Cycle because it's a great place that gives you news and articles and also inspiration about maybe ideas that you could implement in your stores and technologies. There's a lot of, when there's a big announcement about either an acquisition or a new product or something like that, it typically ends up in Full Cycle. I want to kind of walk you through what we're going to focus on today, which is the meaning of the asset sale and then how the assets are actually purchased and either depreciated or expensed on the balance sheet. And we'll really talk mostly about that. And then we'll also talk a little bit about the lease or the property. Because again, the laundromat could be making $0 in net income or negative amount in net income. But if you're on a $2 million piece of real estate, obviously the real estate is valuable too. And Same thing, it could be very profitable, but if you have a terrible lease and there's 1 year left in it, it's worth zero. There's nothing that you should pay to buy that business. And so I am going to go through this stuff and kind of explain this is really where you start when you're trying to evaluate either your own property or a property that you want to look at purchasing. So again, just a quick review, there's a lot of different types of earnings, and we're going to get into that. But first, we're going to focus on assets. So anytime you buy a laundromat, I say anytime, but it's probably 99% of the times, what you're buying is considered an asset sale. And people hear that and they think, oh, that just means I'm buying the assets of the laundromat. Not really. No, you're still buying the earnings. The asset sale is how you are buying the earnings. You want to be able to depreciate every asset at the price of which you purchased it. And if you were to go in and buy the company that owns the laundromat, right? And so that would be like a corporate acquisition. So if, Liberty Laundry LLC owns Liberty Laundry. And so if you came in and buy Liberty Laundry LLC, what you would also be buying is all the books on Liberty Laundry. And if you bought those books, you would see that we've already taken all the Section 179 elections on all the equipment. And so you now have to pay taxes on all the profit, but you don't get any of the benefit of all the money that was spent on the equipment. So that would be very foolish. You want to buy the assets, bring them into a new business entity, whether it's an LLC filing as an S Corp or an incorporated, whatever it is, you want to bring in fresh assets so that you can depreciate them at the value that you paid for them. The first thing that people ask is like, well, how old are the machines? Why would you ask this? Well, if you have machines that are 20 years old or even older, and they are breaking all the time, they are really not worth much because you are going to have such a hard time keeping those machines going. They're worth something, sure, but when you hear this zombie mat, a lot of times what they're talking about is the machines are just total junk. So if we can all agree then that the assets are worth something aside from the business, no matter if the business is generating revenue or if it's negative in the revenue because of some mismanagement or some choice of management, machines are worth something, right? A modern laundromat typically has $500,000 worth of relatively new machines in it. And so those are worth something, right? My advice to you as a buyer or a seller or as just an owner, understand what your washers and dryers are actually worth. Now, they're not worth as much as the day that you bought them. And if they're 20 years old, they're not worth $0. But 1 year old, they're worth most of what you paid for them. And 20 years old, they're worth nearly nothing, or they're worth 10% of what you paid for them. So think about a 1 year old car. That's almost the same as a new car as long as it's been well taken care of. If you look at a 20 or 30 year old car, you know that thing is just going to be a money pit, right? So it's going to break down all the time. It's going to cause more trouble than it's worth. One of the first things you'll look at is what are the machines worth? And I think you should write it all down, put a value on it, and then keep that value in mind because you're at least going to manipulate the earnings based on that. And that is what brokers, buyers, and sellers all do. So it's going to help you keep track of the transaction in your own head. So when we talk about a balance sheet, and you might have a buyer ask you for your balance sheet, what they want to see are all the assets in the business. But if you bought washers and dryers and Section 179 elected to expense them out, which means instead of like a 10-year, 15-year straight line or accelerated depreciation, any of that, you're just saying, hey, these washers and dryers, that was a $300,000 expense, and I want the full tax write-off today. Great, that's what Section 179 is for. It's the industry standard, it's widely used. But then you want to maintain the value and the year that they were purchased on your balance sheet so you can see, okay, these washers were $500,000 5 years ago, and now maybe they're worth $300,000 or something like that. but that wouldn't be on the balance sheet. It would just show the original purchase price, and then it'd probably show minus $500,000 section 179 deduction. And so that will be on the balance sheet to help you understand when the machines were purchased, even though they're technically have already been fully depreciated out of that business. So they're on the balance sheet as a record, but they're not literally worth anything on the balance sheet. But there's some other stuff you might notice on the balance sheet as well. Like you might see a trade name, and why would that be on the balance sheet? But it is worth something. If you have a brand, like in Tulsa, Liberty Laundry is a great brand. People go to, if one of our laundromats is closed, they'll go across town to the other laundromat under the same name, and they'll pass 5 or 6 laundromats on their way because they have loyalty to our brand and our style of managing the business. They know it's safe. They know all the machines are going to work. They know there's kind ladies there to help them. And they have the loyalty card from our store as well. There's things on the balance sheet that you might see that are going to be depreciated. You'll see things like goodwill or covenant not to compete. Let's say you get a lawyer involved and the lawyer wants you to break down all these assets that you're buying from the seller. And she says, okay, you're going to pay X amount for goodwill. You're going to pay X amount for covenant not to compete. You might see the trade name on the balance sheet. There's going to be line items that the lawyer is going to ask you to do. And you might be tempted to say, well, I don't need to buy a covenant not to compete. The owner's retiring, whatever. That's really not the point. The point is that you are buying the earnings, but you're buying the earnings through an asset sale. And so every piece of that earnings has to be associated with an asset. And so the asset that you might be buying might just be goodwill, which is essentially just a bucket of saying, these are the earnings. We're going to put the earnings in the goodwill bucket. I'm saying like, yeah, it's goodwill because I just assume that people will keep on coming to this laundromat, right? It's kind of an intangible asset that you would be purchasing, but you're not really purchasing it. You're really just allocating that part of the earnings to those intangible assets. So a quick summary on this. Laundromats are not just a value of their assets, but I do think the assets have value to them and you should calculate that value. In the case of a bad lease agreement, or in the case of, there's certain situations where they might be less than the assets that they had. If the machines are worth $10,000, it would cost you $10,000 to move them. So they might be worth more or less than the assets. But finding the assets, I think that value is the first step to valuing the laundromat. Just write down on the page what you think the machines and the assets in the building are worth. When we did this, when we closed on our laundromat, I got too focused on, okay, how much is goodwill? What is the covenant not to compete? What value should we ascribe to each name of each asset? And then we're like, oh, the machines, maybe they're worth $200,000. Okay, so these all seem like arbitrary decisions in the moment when you're buying it because you've already probably agreed on the price. We'll get into how you agree on the price later. But then you break everything out through the asset sale. You break out all the earnings. You apply some to machines. You apply some to goodwill, whatever it is. That actually makes a difference on your tax returns in the future, because if it's machines, you can Section 179 deduct it and make your net income zero the first year. Even if you've made $1 million in profit, net income still shows zero because all that profit went into equipment. So kind of an edge case that might not happen often, but I'm kind of hearkening back to why net income is not the thing that you should be looking at when you buy or sell a laundromat. The assets to which you apply the earnings to are important because they are all depreciated at different rates. So you might have a 15-year straight line, and so it takes that number away from your profit each year, so you pay that much less taxes each year. Or if it's equipment, you recoup all that the first year with the Section 179 election. So what I would do, instead of obsessing about the names, I would actually research how fast you can depreciate something, and then you can kind of have an idea of how much do you want in each bucket, and then you can approach it from that perspective. So we haven't even gotten to the earnings yet, the different types of earnings you can get into. We've just gotten into the assets. We're not actually going to touch on all the earnings today, because the second thing that's most important is the leasing or the real estate, right? And so obviously, if you can buy the building and the laundromat, do it, right? Because real estate is just one of the most stable, one of the best investments, but most importantly, you get a subsidized loan to buy real estate. So if you get an SBA loan, they'll give you a loan at a lower interest rate just for the real estate than if you got an SBA loan for the equipment. It's actually a longer loan that you can repay as well. So if you can do it, as long as it's not totally unreasonable, because that becomes clear because of what we're about to get into, which is the lease. Now, an ideal lease, let's just start with, okay, what's a good lease? What's a bad lease? Let's just start with ideal lease when you're going in to buy a laundromat. Ideally, you want a 25-year lease, but it's not just a straight 25-year lease. It's in 5 arms of 5 years. My friend Dan Brinderson really helped me understand this. He buys a lot of laundromats in the California market. He owns Express Coin Laundry. Really nice guy, very knowledgeable. But the reason you would do 5 sets of 5 is because, let's say you buy it, you put the equipment in there, and it just doesn't produce revenue. There's no demand. Maybe there's some big franchise store next door that you have to compete with that you didn't know was going to be built there. Who knows what it is? But you want to be able to get out in that first 5 years. You don't want to be stuck there for 25 years. It is essentially a 25-year lease, but every 5 years, there's an out for you. Now, those arms are your option, not the landowner's option. So it's not like they can kick you out every 5 years. That's not what we're talking about here. So it's a 5-year initial lease with your option to extend it 4 more times for a total of 25 years. That is the ideal lease that you're going after. Now, I said that sometimes a laundromat is worth less than the assets in the building. Why would that be? Why would it be worth less than the assets? What if the owner of that building already has plans, already has a contract in place to have a new business in that building that is the laundromat? If that's the case, then the laundromat owner now, he knows that he's going to be out in 12 months, right? And the equipment in there is not really worth that much. Maybe the brand, if it's a single store owner, which is typical, maybe the brand really isn't worth much. I mean, it really is the location in the store, the physical laundromat is where all the value is, right? And so if that's going away, if the physical location is going away, even if the machines in there are worth, let's call it $100,000, and there's 12 months left, I would say that is worth zero. And the reason I would apply no value to that is because you go through the whole transaction, you spend all this time. Typically, these transactions take like 6 months at least, right? So it's not like you just buy it today and then you get the cash flow tomorrow. That's not that is not what is going to happen. So once you go through the whole transaction, then you've got the remainder of that lease to just recoup some of your cash. And then at the end of it, how are you going to sell those machines? Maybe you can sell them for $20,000 because someone has to come uninstall all of them and then install them in a new location. And they do break when you do that. So they're not going to be in the same condition when they get installed. In that situation, if you have old machines in a location that is not going to be renewed, there is no reason to buy that laundromat. I don't think you're going to arbitrage that deal. What happens in that situation is the owner just gets as much cash out of it as he can. Maybe he sells the machines before he has to get out of the building. And that's how that winds down. There's no way that you go in there and you somehow succeed there. So the lease is very important. So you want to have an understanding and a contract in place with the landlord. So let's get into the caveats of that contract. So when you look at the new lease that you're signing with the landlord, the first thing we talked about was the term, which we talked about a 5-year initial term with 4 options for the laundromat owner to renew another 5 years each time, which is a 25-year total. In that lease negotiation, with the standard term plus the options to renew, the landlord will want to have price increases to keep up with even just inflation. That's a very fair and normal thing for them to ask for. Go ahead and negotiate it now. Give them a 3% price increase every year. That's probably below real inflation, right? And then it gives you some predictability on the location. The last thing you want to have is no agreement on the price increase, and then they bump it up 5%, 10%, 15%. They could bump it up 100% if there's nothing in the contract against that. And so if you're committing to 5 years, you want to know what the price is on year 2 and 3 and 4 and 5. And so negotiating a 3% annual price increase at the time of the agreement is a good way to go. Probably the second place that you want to look after that would be in the personal guarantee. And a personal guarantee is very common. Every landowner is going to ask for it. What a personal guarantee is, to just explain real quick, is they're saying, okay, sure, your LLC, which, let's take Washington's Laundry. So Washington Laundry LLC, you're going to buy equipment, you're going to get loans, you're going to put in machines. Maybe the machine's already there, you're just going to keep them up or replace and repair. But that LLC is going to be operating that building. And if that LLC goes to zero, you still are responsible for some of the rent on the building, because you can't just say like, hey, we're going bankrupt next month. Sorry, we'll be out of the building and you'll have zero revenue to the landlord. They're not going to like that. And they typically won't sign that kind of a deal. They're going to have you personally guarantee some amount on that space, so that even if you do something crazy with Washington's Laundry LLC, you're still on the hook for the monthly payment of that rent. What they will do by default is just a full personal guarantee. What you should actually do is tell them, hey, if I need out of this, I'll give you a 7-month personal guarantee. So once I notify you that we're going out, I'm closing the business, the LLC is going away, even if that happens, I'll stay on the hook for the next 7 months worth of the rent. Now, obviously, if they take no personal guarantee, that's better for you. If you can go without a personal guarantee, do it every time. It's just that a lot of times they won't accept that. And so you don't want a full personal guarantee, especially if you're not able to negotiate those options to renew. What if it's a 25-year lease, just 25 years straight, and then you're personally guaranteeing that whole 25 years? That's crazy. You don't want to be in that kind of a legal mess. And so what you want to do is give them a 7-month out. And this is not a foreign idea. Imagine that you're renting a house, and let's say that you just renew automatically every year in that rental house. But then when you're ready to move out, you have to give the landlord a certain time notice. Let's say it's 90 days. That gives them 90 days to find a new person for the house. Well, commercial real estate is harder to find a new tenant. And so you need to give them about 7 months is usually the typical minimum that they would accept. Let's say you've got a 7-month personal guarantee. You know the location is not working. Let's say you're 24 months into it. So obviously you're not going to take any of your options to extend the lease, but you're 2 years into it and you're saying, man, this is just a nightmare. So I'm going to notify my landlord and I'm going to tell him, hey, I'm invoking the 7-month personal guarantee clause. I'm going to cover the next 7 months through the laundromat, right? You're still personally guaranteed, but I need you to start looking for another tenant now. And if he finds that tenant in month 2, you got to get out of there. Once he has the new tenant in there, that releases you, because what it really is a promise that someone will pay that rent. If you're not there as a business, typically they're not going to ask you to pay for it. So what you would essentially do is say, hey, I'm giving you your 7-month notice to find a new tenant. And that reduces your personal liability on that business, because most landlords will want to pierce the veil. They will not care that, your LLC is making a deal with them. They want a personal guarantee on top of that. And that's very standard, especially in places like California. So the next thing, so we talked about the length of the agreement, 5-year initial period with 4 options to renew another 5 years. So 25 total. Then we talked about limiting the personal guarantee to a maximum of 7 months. The third gotcha to look out for is called CAM. You always talk about people call it CAM, CAM. And what that is, common area maintenance. And so maybe you're not the only tenant in that building. The landlord has to take care of the parking lot, right? That needs to get resurfaced. They got to take care of the shrubs and the bushes, and they got to mow. They have to maintain that property. And they're going to pass those costs on to you as the tenant. So the CAM fees, you want to either negotiate these as a flat rate that maybe has a price increase just like your rent does, or you want to negotiate it as just a percentage of the monthly fees. So let's say you're paying $5,000 for the location. Let's say you want the CAM to be no more than $500 a month. That's a pretty reasonable thing to put in the contract. The lower you can get that, the better. Obviously, it's going to depend on the region, the requirements of that building. Maybe you're in a really high traffic area and there actually is a legitimate reason to have a higher CAM. That's okay. But what you're wanting to do is putting something in the contract that protects you from the landlord making your CAM ridiculous, right? Because if you're paying for the CAM, they have no incentive to make sure the lawn guys aren't charging them 3 times as much, to make sure the exterminator isn't charging them 3 times as much. The parking lot, when that gets resurfaced, that's really expensive. And so if that's going to be $10,000 versus $100,000, you want them to be aligned with your interests and getting those things done for the lowest price but best quality possible. And so a good way to align those interests is to put a cap, either as just a fixed rate that increases every year, or you do it as just a percentage of the lease, and the lease is increasing annually anyway. So just to summarize, when we talked about the lease, you want to get at least 25 years for a new lease. The way you want to structure that is an initial term of 5 years with 4 extensions of 5 years each. You want to lower the personal guarantee of the lease as much as you can. If you can get 0 personal guarantee, congratulations. Most of us can't. So you want to lower that to maybe a 7-month personal guarantee. Don't personal guarantee the whole 25 years. And then the third thing is the CAM, or the common area maintenance. You want to put some kind of cap or some kind of clause in there that aligns your interest with the landlord so that they're not using the most expensive guys for every single thing and then passing all of that expense on to you. You want a 3% annual rate, go ahead and negotiate it now. And then same thing with the CAM. Let's say it's a 3% annual increase, negotiate it now. There's very few existential risks of owning a laundromat. One of them is that the laundromat burns down, but one of them is that the landlord just doesn't renew your lease. And when that happens, it's very hard to retain the value that you've built in that business. And so if you own that property, even if you have to take out a loan for it, not only will the value of that real estate likely increase historically, we can go back and say, yeah, real estate's a pretty good investment, but also it substantially de-risks your business. I would say more than anything else. You just buy the property and then you can own a laundromat on that property for as long as you want to. I will have a link to this and we'll do 3 more episodes about this, but next time we are going to start getting into the earnings multiples and really trying to figure out, besides the assets, besides the lease, the earnings, and what does that add to the value of the business, whether you're buying it, owning it, or selling it. Thanks so much for joining me today, and I'll see you next time.